Based on the Q3 2026 earnings call transcript, the minus 17.97% drop in Accenture's stock price was driven primarily by sudden macro headwinds, discretionary spending pullbacks late in the quarter, and deal delays. The main concerns for analysts and investors from the report include sudden slowdown in discretionary spend and macro uncertainty. Management noted that the indirect impacts of macro environments and geopolitical tensions began hitting the business sharply in the last few weeks of the quarter. Q4 guidance risk. Because the slowdown occurred so late, CFO Angie Park highlighted that more of the guided range is in play for Q4, signaling to analysts that performance could lean toward the lower end of expectations if these trends persist. 2. Geopolitical headwinds. Middle East conflict. The conflict in the Middle East created a $100 million revenue headwind in Q3 compared to initial expectations. The conflict or decision-making cycles impacted overall sales by roughly $400 million across the Middle East and EMEA regions. This impact hit the higher-margin consulting segment entirely. 3. Tepid consulting growth. While consulting bookings remained solid, constant currency consulting revenue grew only 1% in local currency. Analysts worry about backlog conversion speeds as clients pull back on shorter-term discretionary consulting projects in favor of larger, longer-term overhauls. 4. Push out of large managed services deals. Slippage to FY 2027. A couple of large, lumpy managed services opportunities originally expected to close sooner were pushed out entirely into fiscal year 2027 due to company-specific reasons. This directly muted the immediate growth outlook for upcoming quarters. 5. Increased debt to fund capital deployment. Accenture announced it is raising its capital deployment expectation to $9 billion for the fiscal year, up from $5 billion, largely driven by major platform-led acquisitions in cybersecurity. To fund this massive M&A push, the company noted it expects to access the long-term debt market to optimize its capital structure, adding an element of leverage shift for analysts to monitor.